This week on Wall Street Week, raging inflation, the president and international diplomacy, and a surging U.S. dollar.
There's a lot going on. You have a host of global issues, energy crisis.
Massive divergence in monetary policy.
Special contributor Lawrence Summers on what the Fed can do from here.
We are asking for our central banks to analyze the economy accurately.
And Rockefeller Capital Mgmt CEO Greg Fleming on what asset managers are looking for in this rough climate. This is Wall Street Week.
The June inflation report, it came in red hot, fueling talk of yet another 75 basis point rate hike or even 100 basis points.
Certainly the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time.
I fully support another 75 basis point increase. However, my base case for July depends on incoming data. If that data come in materially stronger than expected, it would make me lean towards a larger hike at the July meeting.
As President Biden wraps up a trip to the Middle East in hopes of gaining assistance from Saudi Arabia in lowering gasoline prices.
We had a good discussion on ensuring global energy security and adequate oil supplies, and I'm doing all I can to increase the supply for the United States of America, which I expect to happen.
And underscoring a summer of volatility, the euro plunged below parity, something that hasn't happened in 2 decades.
Tweet of the morning from Sam Rowe on euro dollar. Add on Twitter, Lisa, big win for travelers who are terrible at maths. Euro dollar parity. That's brilliant. That's brilliant.
How do you start our package there and end it with John Farrell? I don't know who made that decision, but we say welcome to you. I'm Tom Keene alongside Lisa Abramowitz. We are not David Weston, but we've had so much fun here on a Friday to bring you Wall Street Week on Friday and, of course, into the weekend. And, Lisa, we've got to start with a hallmark of a great show. Lawrence Summers was on fire when I spoke to him this morning. But to me, Lisa, the hallmark of the week is how many times did you and I look at our Bloomberg terminal and it didn't look normal. It was odd.
It was a wow week, and it was a wow week away from stocks, in currencies, in commodities, as the market really spoke to recession fears, to recession risks. We saw that in commodities such as copper and oil, and we saw that very much with the dollar, Tom. That has been a big theme of the week.
This is a much-watched, much-listened show for you for the next hour. As I said, Professor Summers was lit up on the Fed and, frankly, on some of the emerging market tensions. We saw Gregory Fleming will join us, really one of my heroes in what he did. And what's interesting about Greg Fleming is the Miami Marlins is his fault, just so you know. It's his fault on a banking transaction with Jeter, but it's going to be great with Greg Fleming.
Let's get a sense, though, of what actually happened in markets. Because if you take a look at what the extreme moves were in the dollar, in copper, in oil, you did not see it in an S&P that basically ended the week
flat.
Basically flat. I mean, it was down less than a percent, but that's basically flat after the correction and the carnage of this year. But if you take a look at that dollar index, that is where the drama stood. The strongest dollar going back to 2002 at one point. We did retrace some of that, but we saw that with the euro dollar parity, which perhaps is why John Farrow took an extended weekend. Yeah, exactly. And he was laughing about Twitter. And then copper, Dr. Copper, the gauge on the economic outlook, having its worst week in a year. How much is this pinned to China? How much is this pinned to a forecast for an economy facing a lot of hurt?
And what's important here to round up the data check here across equities, bonds, currencies, commodities, is it was amazing how equities were removed from what we saw in the gyrations of the others. And to the copper point, and we failed this week on Bloomberg surveillance, folks, in that we didn't talk enough about China flat on its back.
We talked about China every time we did. We said we're not doing this enough because that's how important it was. Because there was a feeling of crisis, and it was underpinning this feeling of global recession.
Yeah, we'll get to the incredible week coming up here as well with the ECB meeting. Mr. Fleming will join us later along with Professor Summers, but right now it is a joy to go into the trenches on Wall Street Week of strategists and thinkers on Wall Street adjusting in real time. Lori Calvasina is with the RBC Capital Markets. She is exquisite at small caps and mid caps and also the gyrations of the market. A lot of good work there, bouncing off the work in economics of Tom Porcelli. David Bianco is an institution far too young for the years on Wall Street at Deutsche Bank and now with DWS Group America. So valuable. I think he walked out the door and they brought him back a second time. Two of you, thrilled to have you on what is absolutely an oddest week in years. Lori, were equities removed from the turmoil in the other asset classes?
I think they were a little bit this week, but frankly, I think they deserved a bit of a break after the year that we've had in the past couple of months that we've had. Look, I think investors on the equity side were also gearing up for earnings. And we were in a little bit of a holding pattern until we got to the end of the week. And financials, I mean, there was definitely interesting moves in financials today once we finally got through the kind of breakout.
Say, Shanali Bassick aged this morning. David Bianco, help me there, because in your research note, you say the banks are of interest, but the banks are all varied. Which kind of bank is where investment should be today?
The big banks, the ones that have sticky deposit bases, the ones that will benefit from the Fed hiking and the continued Fed hiking. So it's not comfortable to own banks if we're perhaps heading into a recession. But even if we do have a recession, this is not going to be a deflationary type of financial crisis. I think the credit costs will be well behaved and the banks will do fine.
How much are financials an idiosyncratic story versus a story of macroeconomic strength, really? Because that really was the feeling when JP Morgan came out, and over time it became something different.
Well, it's a good question. And I do think when you have, it's hard, financials are always a macro story. It's very difficult for financials not to be sensitive to the macro and purely idiosyncratic. However, what's happening in the macro situation right now is inflation and the Fed hiking. So who's the only beneficiary of interest rates going up? It's banks. Everybody else is worried about that, not just in terms of slowing economy and earnings and PE pressure, but banks benefit, at least with higher earnings from higher interest rates.
So given that backdrop, Lori, and given the fact that you said that really stocks were somewhat immune to the volatility we were seeing in other asset classes, what are we pricing in? Is there a disconnect right now between the asset classes with stocks painting a much more sanguine picture?
Look, stocks are pricing in a recession at this point in time. I mean, we've moved beyond kind of growth scare territory, which is where we were for the first part of the year. Now we've been down around 25% from the peak or so. And your typical recession drawdown on a median basis is 27. Your average drawdown is 32. So we're kind of pricing in that short, shallow recession scenario. We're not pricing in a typical recession. We're not pricing in a severe one. We're not pricing in an extended one. But I think the good news, if we do have that short, shallow recession in the back half of the year, the equity market got a lot of that damage out of the way early.
It's asymmetric, or log normal, I should say, actually, and it's so easy to get out of the market, David Bianco, and it's so tough to get back in. I want you to go back. Lou Rukeyser, 1987. How afraid were we in 1987 after that crash? And getting in November and December before that 88 boom in the market was brutal. David, where do you find the courage to get into the market if you're afraid?
How to pick the bottoms, not an easy thing. And the 87 crash of about 35%, that's the only time the market has gone down more than it has now outside of a recession. It's not clear that we're heading.
So there's an equivalency now with 1987?
Well, no, 87 was far worse.
I'm trying to make some headlines here. Stay with me.
This has been a tough market. Lori's right. I think the equity market has largely priced a recession, a small one, but not entirely. However, we have seen how things can get worse, like 87, even when the economy was fairly okay. But you're right that there was a lot of uncertainty around interest rates, the dollar, and the global economy wasn't as important to the U.S. and the S&P back then. But the volatility we see in commodities, currencies, interest rates, the fear of what might happen to credit costs, I am not sure that we should try to pick a bottom and scoop up stocks in one fell swoop, but I do think investors should nibble.
Well,
nibbling gives you confidence.
Nibbling where?
Well, I do like the banks for those who are the braver heart. I think some safer areas are healthcare and utilities.
Well, but Lori, I want to get to this idea of both baking in a recession, but also the Fed, and the possibility that as we see the Fed officials go into a blackout period where we're not going to hear from any of them next week, and some people might cheer, perhaps this guy. St. Louis Fed President Jim Bullard came out today and yesterday and really knocked down the idea of a 100 basis point rate hike, but did raise the specter of 4% Fed funds rates by the end of this year. Has that been priced into stocks?
I think that largely the idea that the Fed is going to be very, very aggressive in here, that's in the market. But I think markets are still struggling a little bit with the extent of the economic damage, and that's what's yet to be priced in. And, I think that markets at the end of the day on the equity side, they just want to know what the path is. They want to know what the exit strategy is. They want to know how far this is going to go. They want a bit of a timeline. We're seeing some investors talking about, bad economic data points and saying, well, we're going to, we've upped the possibility that we're going to get cuts early next year. And that's telling you equity investors are willing to look very far ahead, but we need to stop giving the equity market nasty surprises.
Lori, do you understand the consumer?
I think so. I am one.
So the American consumer supposedly is strong.
Yeah.
And yet we see that they're incredibly worried, and we see that their balance sheets are getting weaker, and we're seeing their savings are getting depleted. How do you understand that in terms of the path of this economic cycle?
So I think there are two things. I think that, at the end of the day, I think we may look back at 2022 and say that this was phase 3 of the pandemic, with 2020 being the year that everything fell apart, everything happened, the health crisis hit, 2021 being the year of the initial recovery, and this year possibly ending up being the year of normalization. So I think we need to think about it in that context from the psychology perspective. And I think there's something powering consumers that we don't quite know how to model as forecasters. And I think, we've been talking about how lousy the consumer confidence data has been since I think about this time last year, and it didn't derail spending. Why is that? I think also, if you think about the consumer, we're starting this crisis from a point of strength, stronger than we've gone into past recessions. Yes, data is going to get worse, but we need to keep that in mind as well.
Well, I'll join a Friday evening and into the weekend as we get to continue with Lori Calvasina and David Bianco as well. Again, we've got so much to talk about here over the hour. I can't say enough about the importance of speaking with Gregory Fleming, as we will here in a bit. And again, Professor Summers was immensely prescient today on some of the images back to 1998. He says maybe panic less and much. It'll be interesting.
Yeah, and that's certainly a theme as we try to chart a path. What did we say this week? That it's not necessarily the question of whether we get a recession, but the path to get there and the path out of it to get back to that 2% inflation rate. We've got much more of that coming up after the break.
The good economic news today was that the U.S. unemployment rate fell to its lowest level in nearly 4 years, 5.7%. And for anyone who still hasn't got the message that inflation is the big problem, the index of wholesale prices took its second straight 0.7 point monthly jump.
The great Louis Rukeyser filming Wall Street Week in 1978 from the Stickley showroom, I think, is where that was. That was a great moment of what Mr. Rukeyser did here, and it speaks to 1978 and Lisa Bramowitz, not of Bob Seger or the moment, but it was, and I'm sure Lou would agree, it was the dismal 70s.
Yeah.
This is not the dismal 2020s.
But this week, we got a number that was close, with the 9.1% inflation shocking markets. And we cannot avoid the rhyming aspect of that, even if this isn't the 1970s.
And one of the things under the radar this week, folks, so important, is compare contrast of Jerome Powell with Paul Volcker. I got some major heat from Wall Street pros. Maybe lose that tone and just start looking at where we are right now. Where we are is with Lori Calvasina and David Bianco with RBC Capital Markets and DWS. Thrilled they could start us out here on the state of where Wall Street is right now. Lori, I'm going to go to you because you are exquisite. It's something no one talks about anymore, not the Red Sox middle relief, but small cap stocks. And the answer is small cap stocks do nothing, and then about every 9 years, boom. Yeah. Are we close to the small cap boom, and why?
Small caps are in a holding pattern right now versus large cap. I think they're waiting for their moment to
shine. Like what, 7 years?
Well, they actually have had a terrible last year and a half.
Okay.
And actually, they've been bad for quite some time. But I think really around 2014 was kind of the last moment in the sun that we had there. But look, I think small caps are telling you that this is a market that wants to start bottom fishing, where people are starting to look for things that have been de-risked. And when I talk to investors about areas of the market that have been de-risked, small cap is the #1 thing that looks like.
But are they small cap because they're zombie companies or because their managements do not merge into mid cap size? What's the the pixie dust of why they underperform?
There's a few different versions of it. There are the younger growth companies that are still up and coming. There's some that have been older and fallen on harder times. And then there are others that are simply a little too niche and haven't gotten scooped up yet. So there's a big variety in there.
David, a lot of this hinges on inflation getting back to 2%, as so many people believe. And this is the distinction people are drawing from the terrible 70s, saying this is different and it is less entrenched than some people fear. What is the risk that that's not the case, or is it a screamingly obvious argument that the Fed will get things back to where they want it?
The Fed will do everything it can do, but it may have a bitter medicine for the economy. So I do think it's instructive to look at the 1970s and try not to repeat those mistakes. It's early in the 2020s. From 1975 to 1979, real GDP growth was 5% plus. So real growth is not going to be that strong in the United States. It's really important that inflation does work its way back to the Fed's target of close to 2%. That's going to require the Fed doing its job, fiscal discipline, and most importantly, a renaissance, once again, like in the early 1980s, of the supply side. Reaganomics combined with Volcker's monetary medicine is what laid the seed for a very good 80s and 90s and thereafter. So we need to learn the lessons of the 70s and not repeat the mistakes.
Meanwhile, as people do bottom fish, and Lori says there's evidence from the small caps, how much are bonds participating in this? Has the stability in longer duration bonds provided a template for that bottom fishing, for that comfort that could even persist longer than people think?
I think investors are better off for now in short duration bonds, Treasury bills, 2-3-year Treasuries. The bond market's not priced for the Fed getting to as high as 4%. And neither is the equity market. That would be a risk. So I think investors should be careful with bonds. Look for inflation-protected bonds, hold on to cash, and then look for real assets, whether it be stocks or real estate or utilities. I do like small caps, and I do like banks for those who are willing to take the cyclical risk. I think small caps have been beaten up even more so than the large caps. And what's interesting about small caps, they were held back over the past decade or two from globalization and other factors. They will benefit more
Lisa,
now.
we got a problem here. Our guests agree with each other.
Yeah, we agree.
Okay, well, here, I think
you and I never agree. They agree.
That's right. That's why we're put on the couch together. I do wonder, though, we're all talking about the United States. We have to zoom out. It is not about the United States right now. It is strong in the United States. In Europe, it's another story with gas, and we are looking to the ECB next week. We are looking to the Nord Stream 1 pipeline, whether it will come back online. We are looking to emerging markets. Tom has been talking about it all week, and some of the crises percolating in pockets throughout the entire complex. At what point can the United States fall subject to what's happening outside in the rest of the world, Lori?
Well, look, I think we had a template for this back in 2018. We spent most of the year thinking the U.S. would be immune from the global recession that would emerge from the trade war, and then recession fears came home to roost and markets fell sharply. But we've already done that at this point in time. So I think we can go back to this idea of a relative game. Will Europe be worse off than the U.S.? If the U.S. is better off, I think there's a limit to the amount of cash that institutional investors in particular are willing to sit on. So a lot of that money is going to find its way into the U.S. and the small caps.
David, I want to go to the heritage of DWS and, of course, the relationship with Deutsche Bank and the giant David Folkers-Landau, who on February 24th or 25th told me, watch the dollar, this will need to be amended. We are now living a dollar surge, and I'd say this week, folks, DXY, the blended large nation index, was caught up with late in the week by the Bloomberg Dollar Index, more EM. David, how do our listeners, how do they adapt to an incredibly large, strong dollar?
It's a tough thing to adapt to. Don't forget the S&P 500, not banks, but the rest is a very global set of businesses, and they're facing foreign exchange rates, and they're going to be facing tougher competition in the areas of auto and machinery and tools from Japan, incredibly weak yen, and Europe, and it's a slower global economy anyhow. David Folkers-Landau from Deutsche Bank was one among the first to warn of a recession coming, and at DWS, the asset management business, I do believe there will be one late this year, early next.
Lori, linking your work with Tom Porcelli right now, he's truly expert on wage growth or the lack thereof. What does terrible real wage growth mean for our listeners?
Well, look, it reduces consumer spending power at the end of the day. There's a weakness, right, to the undercurrent of spending.
Is that what we're going to see in the coming weeks?
I think that you have seen a few companies already allude to the idea that there have been some hits to demand if you read some of the early reporters. So I think that's something we have to watch out for. I think the country's in a little bit of a shell shock at the moment with all the recession talk. But I think that's really, this idea, sort of this undercurrent, this underbelly of weakness that is not captured in the headline data is something to watch out for.
With the data dependency of the central banks, with the data dependency of traders looking at some of these wow statistics that we were just talking about this week, David, what are you trained on to give you some guidance? Because we were talking about the University of Michigan controversial sentiment data and how much people are really trading off of that. What's your compass?
My compass is actually not the consumer. I think the real concerns are on the supply side, something we've taken for granted for 40 plus years. So I'm watching the global economy, I'm watching the conflict, I'm looking at policies both in the United States and Europe and seeing if they're more pro-supply side than they have been in recent couple of years. So I'm trying to get a big picture idea because I want to step up and buy when we have a recession and equities get hurt perhaps a little bit more. But I want to be more confident this is going to be a good decade. And I think we need some better policies. And if we look back and see the 2020s turn out to be another great decade for stocks, I think healthcare will be a big part of that.
That's been a huge theme this week, Tom. We've heard that from person after person. Healthcare, the place to be. Lori Calvasina, David Bianco, thank you both so much for spending your Friday night with us here. And coming up, we're going to take a look further at what to expect, particularly with global Wall Street, particularly with the dollar, particularly with the ECB. That's coming up next on Wall Street Week on Bloomberg.
Let's take a look at the major events coming up around the world this week. I'm Haslinda Amin in Bali, starting with the agenda in Asia. We'll be analyzing major headlines out of the G20 meetings here in Indonesia. Central bankers and finance ministers have gathered after getting their calls on inflation wrong for the most part. Meanwhile, U.S. Treasury Secretary Janet Yellen heads to Korea to meet with her local counterparts on Tuesday. Rate decisions are also due from the Bank of Japan and Indonesia. Plus, we'll get plenty of earnings, including from Macau casinos.
Next week in Europe, it's monetary policy meets the fiscal. There'll be an ECB decision on Thursday, but before that, their decision will be complicated by volatile Italian politics that could see the coalition of Mario Draghi fall apart with opposition from Giuseppe Conte. If that does widen spreads, it will make things more difficult for the ECB, who wants to tighten policy while keeping spreads in line.
Of course, a lot of quarterly results coming up here in the U.S. next week, starting with Netflix and then Tesla. Netflix is really going to be an interesting one, given that it announced more of an ad-supported model to go along with its traditional subscription business. See how much revenue can be boosted by that. Tesla also one that we're following, of course, given the drama in the C-suite and how much of Elon Musk's attention has been pulled away now that he's in a court battle, of course, down in Delaware with Twitter. So Tesla, of course, will also be another big one that we're following. On the economic front, there's going to be a lot of U.S. housing data to also give us an idea of how the housing sector is holding up in the face of a lot of these Fed rate hikes. And as well on Friday, some PMIs, of course, an indication of where we are in this economic cycle, given further calls for a recession. Much more Wall Street Week coming up after this break. Stick with us.
Welcome back to Wall Street Week on Bloomberg. I'm Lisa Abramowitz alongside Tom Keene. And I got to say, Tom, this has been amazing to speak with the behemoths in the field over the dozens and decades of Wall Street history as we try to get a sense of our place in current history.
We're going to do it right now. And in chaos this week from the micro, which is you look at the Bloomberg screen and see where euro is and you go, wait, that's not normal. Or this statistic, the curve inversion that we saw this week. And we did some of that narrowness with David Bianco and Lori Calvasina, but now it's time to go broader.
And we need to get a historical perspective of where we are, and there is no one better to do that than Greg Fleming, Chief Executive Officer of Rockefeller Capital Management, who spent decades running Merrill, running Morgan Stanley Wealth Management and Investment Management. You have perspective running the big wealth management shops of Wall Street throughout history. So what is the best analog from a historical perspective for the moment that we're in?
You know, Lisa, it's interesting. If you're looking at analog, I'd pull back pieces from different times. So we're still in the time that we were in the last 10 or 15 years, where technology is driven deflation and prices coming down and productivity improvement. So that's still here. At the same time, we've got vestiges of the 70s and early 80s in terms of pressure on the energy side of the equation that we really haven't seen to that degree since then. And a real, inflation numbers this week that came in hotter than we've seen literally in decades. So you have a combination of historical times coming together to create the unique time that is 2022.
This moment was a pivot point this week when we got that 9.1% inflation print, when we got some of the data out of banks showing that they were suspending share buybacks despite the fact that it might be mandated by the Federal Reserve. How much do you view the markets as perhaps being overly pessimistic rather than not appreciating the difference of now versus a decade ago?
You know, I think the markets, there's a tug of war every time there's data out. I mean, today people said retail sales were better than they expected in June. Michigan sentiment was better, so they start to, markets go up, and it's like, wait a minute, maybe we'll get through the recession risk and be able to bring inflation down. So you have this tug of war on the data constantly, but the reality is the biggest player here, and you all know this because we've seen this historically, the Fed is focused and needs to stay focused on inflation, and they will. They have got to change the expectations that are getting embedded from an inflation standpoint.
Greg, in the time we've got left, as Lisa mentioned, we want to go bigger and broader with you. And I don't think you've ever gotten the credit for literally inventing modern wealth management. How does it feel like to see every single firm out there do a press release that says, we want to be like Greg Fleming. We need to go to Asia to gather high net worth assets. Gorman's doing 28% gross at the shop you invented at Morgan Stanley. Every Credit Suisse has announced, UBS, of course, leading the way, but Credit Suisse wants to be Greg Fleming. What do you say about an industry where everybody wants to get in?
Well, first of all, what that means is that the business is a good business to be in. And you know that, Tom. The characteristics of wealth management, fee-based advice, counsel to clients, recurring earnings. So it has characteristics, financial characteristics that make a lot of people want to be in the business. What I say, and this is what we're doing at Rockefeller Capital Management, is define the way that we're going to operate with competitive advantage. And what we're trying to do for clients is provide them advice across the full range of their needs through private advisors that are experienced on the investment side, open architecture, an investment platform where you bring in the best of outside managers. We've put together, and we marry that also with family office services. You know, we'll take care of bills, we'll help you with taxes. If you take care of the full needs of clients, you can offer something that not everybody else in the marketplace offers. So we've tried to redefine what it means with high net worth and ultra high net worth clients.
You and I have never seen a bond market like this. The Lehman, Barclays, the Bloomberg total return aggregate, negative 12%. Some of the corporate high grade stuff is negative 18%. How does quiet money manage with bond prices down 12%?
Well, you know, the reality is there are a number of things, including on the macro side, and I'll come back to this, but on the macro side, you have virtually full employment and everybody worried about recession. So there's things, Tom, that even we haven't seen. Back to Lisa's question, what are the historical analogs? There really aren't some for a number of the things we're dealing with here. In terms of the bond market, to have the equity market off as much as it's been this year and fixed income off to the degree that you described, that's something we haven't seen in history as well. So the quiet money was very careful about fixed income when rates were virtually zero across the spectrum.
How much have we fully appreciated the absence of Japanese investors, the absence of certain Chinese money, the absence of some of the international flows amid domestic crises throughout the world?
Well, I think that that's one of the things, Lisa, that's happening both on the financial flow side and even on the trade side, which is the internationalization and the globalization retrenching for really the first time in my career. In the 90s and in the first part of this century, people were focused on following those financial flows across markets from a trade standpoint, from an investment standpoint. All the major financial firms in the U.S. were trying to build major presence in those markets. And now you have a retrenchment back to home markets on both a financial basis to some extent, as well as on trade.
This is inflationary, and it is also perhaps a headwind to true growth, which raises a question of how long it will take before 60-40 works again.
Well, for different clients, you might be rebalancing the 60-40 in a different direction. But I think it's going to take a while for the Fed and for the current situation to work its way out. When you have the kind of inflation numbers that you have now, people are talking about when we're going to be back to 2%. The reason they're going to go after this very aggressively is it's going to take some time to get back to 2%. They need to break the back of the expectation over the next 6 or 12 or 18 months in order to have a hope that a 60-40 portfolio in 24 or 25 might make sense for investors.
And now, folks, it's time for the Wall Street Week question Louis Rukeyser never would ask because this is a rude question. I'm going to ask it of you because you're qualified. I want you to tell me in banking, New York City banking, London banking, and such, the delicacy of chairman and CEO being held by one person at the same time. This is a debate that's out there. What is the efficacy of having a separate chairman and a separate chief executive officer?
You know, in theory, the efficacy is making sure that all the different alignment of interests are in place.
What's your experience?
My experience is it depends on the institution, and you've got a number of examples of very strong institutions with management, doing the right things across the landscape, and shareholder return being where you want it to be, and then you have situations where splitting the roles works. I think it really is. It boils down to looking at individual cases. Tom.
We have an astrolabe, one of those medieval clocks in the surveillance room where we meet every morning, and it's trying to gauge when Credit Suisse is taken out. And the basic idea there is American banking, the siren call of going over across the Atlantic and running into European banking headaches. Should the banks that you built and lived in, should they be buying European bank assets?
I think, Tom, it's more going the other way to the point, Lisa, we were talking about before. I think that major financial institutions, but also, again, back to trade, I think
regionalization.
It's coming back, and it's the first time in 25 or 30 years that that's happened.
Well, to that point, and just to be clarified that orb is an 8-ball, I am wondering whether the expansion into China and into some of the...
I think it's
John's 8-ball. It has the football game of his choice on the backside of it. I'm wondering, though, do you expect to see some retrenchment from financial firms' Chinese arms in the face of some of the international fissures as well as the zero-COVID policies?
Yeah, I don't know about a retrenchment, but much more caution in terms of the level of capital investment, the aggressiveness of the growth strategy. There's no question. In fact, Lisa, you can take it further. You know, I think you're going to see critical industries start to come back on more of a regional basis. And it's an opportunity for the United States, actually, where manufacturing of precision products could take place increasingly here. And who would have thought we would have been talking 5 years ago about pulling manufacturing of semiconductors, of clean energy, and some of the.
Yeah, but all of these things are inherently inflationary. These all are inherently inflation, especially with the dollar where it is, especially because it is cheaper to go overseas and to do it elsewhere. How do we bake that in to our market calls?
Well, I don't disagree with you. I think that a lot of these things are inflationary. And this is why I said that the Fed is going to, in rhetoric and in reality, stay right on top of this because they recognize now that they've got expectations out of whack that they have to pull back. They've got some macro, like what you're talking about, Lisa, where regionalization could create more inflationary pressure that nobody would have conceived of 5 years ago.
Greg Fleming, 1 minute on a Friday evening. You executed this, which was the birth of BlackRock. What a triumph for Mr. Fink, the way they have done that, the way they have executed, not so much wealth management, but almost wealth husbandry. Did you see that coming, or have you been stunned at the success of BlackRock?
It was impossible, Tom, given the magnitude of success, to see it coming. We took it public, by the way, in 1999 at $14 a share. We merged Merrill Lynch's asset management business, as you know, in 2004 or 5 into BlackRock and took back a 49% ownership stake. I'm proud of the role that I played and that we played in helping create that firm. But it would have been hard to conceive of a firm with $8, $9, $10 trillion in assets under management. And that doesn't even really reflect the dominance they've created in certain spaces.
Greg Fleming, thank you so much for spending
Wonderful.
Friday night with us.
Great to see you both.
To hear your insights. Thank you.
Great. Thank you.
And Tom, we have a conversation coming up that is a really important one with U.S. Treasury Secretary Lawrence Summers.
I had to be medicated for this. Professor Summers was on fire today, not only about the central bank, but we started out on the shocks that we're seeing in Asia, and particularly the hugely strange movement of the Japanese yen on a July Friday. Please stay with us. That is next on Wall Street Week. I'm Bloomberg. Welcome back to Wall Street Week. I'm Tom Keenan for David Weston this week, and I'm joined now by someone familiar and deservedly familiar. Lawrence Summers is Wall Street Week contributor. He is a former Secretary of Treasury of the United States, president of Harvard, but far more than that, a contributor to our economic discussion over any number of decades. Larry, I'd like to turn it into a 2-hour conversation, but we can't do that on a Friday evening into the weekend. And I have to digress off the usual Fed discussion here and talk to you about a magazine cover of February 15th, 1999. Greenspan Rubin and a younger Lawrence Summers in a time of Asian crisis. With dollar strength and with anticipated Fed rate increases, do we see an emerging market fragility which could lead to something related to the August of 1998 that you lived?
I doubt it in the same way. Central to that crisis was fixed exchange rates, were very low levels of reserves in many emerging market countries, and were debt that was predominantly or heavily dollar denominated. I do think that the combination of high energy and food prices, a rising dollar, and increasing interest rates does pose risks to emerging markets, but I think they're not likely to be systemic and across the board in middle-income countries. I'm more concerned about countries with particularly unsound policies. Turkey would be an example, or Argentina would be an example. Countries with particularly problematic food situations. Egypt would be an example. But I don't think there's going to be the kind of massive across-the-board financial distress that we saw earlier.
Professor Summers, I saw a chart this week on the Bloomberg I've never, ever seen in my life, which is the zombie nature of Japanese yen weakening. Again, this is away from the United States, but when you see the lethargy of yen weakening, given the experiment of yield curve control, how would you suggest that will end for Japan? How would you suggest that will end for the markets?
You know, Tom, the problem with pegging financial variables, whether it's an exchange rate or a long-term interest rate or a stock price, is that it tends to be a much easier strategy to enter than it does to exit. And I think that's got to be an issue for Japan. Sooner or later, they're going to have to leave the yield curve control strategy, and I'm not entirely sure what's going to happen when they do. I think in the meantime, the pressures are likely to build, and as they provide more and more liquidity, it could easily lead to an even weaker yen, especially given that as inflation surprised on the high side here, market participants revised upwards their expectations of how high interest rates are going to have to go in the United States.
Larry, let's get back to the United States here. And just as a general statement before we look at 9.1% inflation, are we asking too much of our central bank? We had a massive fiscal expansion. I guess we're trying to do a fiscal unwind off this pandemic. Are we just asking too much of our central banks today as an institution?
I don't think so. I think we are asking for our central banks to analyze the economy accurately. We are asking our central banks to keep in mind their primary mandate of price stability. And frankly, I think in 2021, our central bank lost its way. It was talking about the environment. It was talking about social justice in a range of things. It was confidently dismissing concerns about inflation as transitory, and it made mistakes in the core functioning of a central bank, including leaning into highly expansive fiscal policies rather than accommodating them as our central bank did. So I don't think we were asking too much of our central bank, but I think in 2021 our central bank let us down quite badly, and as a consequence they find themselves in a very, very difficult position, not least because they don't have the credibility that they once enjoyed, given their repeated poor forecasting record. And I have to say that it's not something that's been fully fixed. Their most recent dot plot suggesting that unemployment would get only to 4.1%, even as inflation came completely down, seemed to me to be highly implausible. And the fact that the most pessimistic person of the 19-member open market committee was saying 4.5% seemed to me to suggest a degree of highly problematic groupthink.
Larry, you've taken a victory lap among all in economics here with how far out front you were on inflation. I want to go back to a modest textbook of 1948 by a guy named Samuelson. And like 2 years later, 1 year later after the 1948 miracle of his textbook, there was sky-high inflation like the 9.1% inflation we have now. Not once, but twice we came down into the Korean War, into an Eisenhower disinflation and outright deflation. Do you have an optimism we can move from 9.1% inflation down relatively rapidly?
I think it's pretty clear that there are some factors, like what's just happened with gasoline prices, that are going to point towards disinflation. But I think that if you look at core measures of inflation, if you look at so-called trimmed mean, a range of different indicators, what they tell you is that this is a pretty pervasive expansion in inflation. And my reading of the experience of the last 60 years is that those don't tend to be reduced completely without significant economic slack. And I think if you look at the level of vacancies in the economy, the ratio of vacancies to unemployment, or the level of quits, you see that we have a currently overheated economy. So we have some distance to go just to get back to neutral.
You wrote an initial paper with a guy named Martin Feldstein. This is a few decades ago, to say the least, Larry. He codified NBER as our measure of recession. And your colleague, Jeffrey Frankel's done great work on this. Like, actually, how do we choose to define a recession and the magnitude of recession? the parlor game right now of recession I've never seen, the guessing of it, the gaming of it. Give us some clarity on how you define recession and the magnitude that we could see.
You know, I think the classic definition of a recession is a broad-gauged, multi-month decline in a range of economic indicators of activity. And that's something that the NBER makes a judgment about. There's a kind of crude approximation that many economists use, which is 2 negative quarters in a row. I think there's a quite reasonable chance, probably 50% or a bit above, that we will in the first and second quarters have negative growth in both quarters. I don't think that is itself sufficient to establish a recession because it's heavily being driven by demand that draws down inventories and demand that draws in imports. But I think there's a real risk that we'll see it through this year and an even greater risk that we'll see it next year. I would say the odds are certainly in the far above half, probably above 3/4 of seeing a recession within the next 2 years. And I don't think there's any reason why it needs to be a recession like we saw in 1982 or like we saw during the great financial crisis.
Right.
But I think it's not going to be a walk in the park either. And I would suggest as a kind of rough model what we saw after the bubble burst in 2000.
Larry Summers, we've got to leave it there. And again, as I speak to you, I haven't spoken to you in a while. Congratulations on truly one of the great calls in modern economic history here, questioning transitory. Lawrence Summers, thank you so much. We'll be back with Wall Street Week in a moment. This is Bloomberg.
This is Wall Street Week on Bloomberg. I'm Lisa Abramowitz here with Tom Keene. And Tom, next week is going to be a tremendous week with the European Central Bank in the forefront.
It is.
Facing a rock and a hard
Yeah,
place and hoping to find some peace.
I just want to say to everybody who's joined us here with Greg Fleming and Lawrence Summers and David Bianco and Lori Calvasina, Lisa and I were sitting together and it looked like marriage therapy, so we got a setting here different to end the program. This looks a little more casual. I'm still numb from this week. I will read it over the weekend, and we will go to what our colleague John Farrow, I believe. He says this is the mother of all ECB meetings, and particularly for people in America where it's like the lady that was with the IMF, she comes out, she does a press conference and that. No, this time's different. The ECB meeting's a huge deal.
Especially because a guest on surveillance this week was talking about how this year, this time around, it's not emerging markets. This time, it's potentially Europe dragging down the rest of the world complex, just simply because of the crisis they face with gas, with the crisis they face with negative yields, et cetera. Next week will be a real interesting
There's no one more qualified in the world to know that Christine Lagarde, to say that it is EM together with Jerome Powell, together with Christine Lagarde, together with Bailey of the Bank of England. I'm not sure I buy the Europe-only analysis. Did we do okay today?
I think so, because we're still sitting here next to each other. I guess that the therapy kind of
Somebody emailed and said, how did a guy in triple leverage cash do Wall Street Week? I said, I don't know.
We've been in therapy the whole time. This is Bloomberg.